Ticker symbol EXEL is up over 70% in the past year, and today we'll be looking at a company which provides stable free cash flows, possibly trading at a discount. This company has been managing consistent, stable revenue growth with a 150% year-over-year net income growth, and ticker symbol EXEL has had an incredible net margin expansion in the past 5 quarters. So today we'll be looking at none other than Exelixis, an oncology provider. Now this company, through R&D, has developed 4 marketed products. 2 of these come from their flagship molecule, which is called cabozantinib. They have developed this molecule which can basically target and block specific proteins found in cancer cells, which are responsible for all the processes that allow these cancer cells to spread out across your body. So what this molecule does is that it targets those cells and it blocks the spread of cancer, and it keeps the cancer very local so that you are not faced with the horrors of metastasis, which is when cancer has spread out all over your body. And this was a huge breakthrough in medicine, and as such, they have had over 8 years of annual profitability with an over 16% product growth year over year and a 22% increase in royalties earned from all their partners that are not found in the US. As you may have found out already, this company has 2 main sources of revenue. One of them is through selling their 4 marketed products, and the other one is by selling this flagship molecule to other partners, other pharmaceutical companies, so that they can create their own products using this molecule. And that segment has been their major avenue for growth. In their annual report, they stated that they have a very thorough plan in order to invest their cash flows. And with them, they plan to develop and advance through a wide array of other treatments to treat cancer and support ongoing trials evaluating their molecule cabozantinib. In their pipeline, which is where we can find all of the products that are being developed by Exelixis at the moment, we can find sanzalintinib, which is a refined version of the other molecule that we spoke about, and XB002, which is another type of product. And this XB002 is the most interesting one because it doesn't act as their molecule, which only targets and blocks the cells from actually expanding all over your body, but this product actually finds those cells, attaches to them, and delivers a toxic payload to not only block them, but to kill them and hopefully cure cancer once and for all. And this is the most exciting product out of their pipeline, which is the one that is mainly driving their stock price. But since this company has created something unique, their financials look extremely good. They have a return on capital employed of 27%, way above our 15% threshold. They have an interest coverage ratio of over 100 times, meaning that they won't have to worry about debt anytime soon. And they have a cash conversion rate of 97%. On the other hand, they have a gross margin of 34% and a net margin of 24%, again over our threshold of 15%. And when we look at their financials, I'm happy to say that it's very hard to find a company that looks as good as this one. As we stated previously, their net income has surged by over 150% in the past year, and this has mainly been possible because of a great, very consistent top-line revenue growth and because of an incredible net margin expansion, where their net margins are sitting just under 25% now. And as we usually like to say, efficiency ratios usually follow net income, and in this case we can clearly see that in the past year, their efficiency ratios have gone through the roof thanks to the revenue growth, but also the net margin expansion. And this has allowed for their return on invested capital, which is the ratio that we tend to focus on from this slide, to rise above 25%. On the other hand, we can look at their balance sheet where they reduced the total assets outstanding from 2022 all the way up to now, and they could pay off all of their total liabilities over 3 or 4 times just by using their total assets. This company gets a 5.5 out of 8 ticks, starting with their low liability risk as we saw with their over 100 times interest coverage ratio. Then they have a very solid balance sheet as they can pay out all of their short-term liabilities only by using their current assets. I'm happy to say that this company is extremely good at generating consistent cash flows, and as we have seen, they're able to also grow their revenue organically. By organic, of course, we mean that this company does not depend on M&A, all of their growth rate is organic. Now, when we move on to the 2 most important factors from this slide, which is their pricing power and their existing moat or competitive advantage, I believe Exelixis has them both. On the one hand, we usually consider pricing power the ability of raising your prices at a rate above inflation for a long time without losing too many customers. And when it comes to healthcare and these type of products, I would be willing to pay any kind of amount in order to get out and survive cancer. So on the one hand, the demand that they have is extremely inelastic, meaning that it's not sensitive to prices at all, because humans would pay everything we have in order to keep living. It's our instinct. But on the other hand, they don't have that amount of pricing power, because whenever you get a patent or whenever you're in this segment, which is extremely and highly regulated, your prices are also regulated to ensure that you're not raising them above a certain level. This is put in place to ensure that pharmaceutical companies don't take advantage of customers and charge them only what is strictly necessary. So although in these terms, usually they are allowed to increase their prices every single year, they're not able to increase them as much as a company would want to. And when it comes to their existing mode, I believe that there is no purest form of competitive advantage than one which states that you are the only company able and allowed to produce this product. And that is exactly what they have via patents. When Exelixis developed the molecule known as cabozantinib, they of course decided to patent it because it's something extremely useful, it's something that they created on their own, and it's something that they have the right to commercialize by themselves. Of course, what they have done is to license these permits to other companies such as Pfizer in order for them to also be able to produce products including this molecule, but in exchange, Exelixis gets royalties from those products, which I believe is very fair. But as a summary, they are the only company that is able to produce that molecule, and everyone that sells that molecule has to give some sort of revenue back to them. However, there are two things that I did not quite like from the fundamental analysis, starting with the fact that they don't pay dividends and they don't conduct share buyback programs despite being profitable for 8 years in a row. And the other thing is that I have not seen their organic free cash flow growth in the past year. It has more or less been stable. Now when we look at their valuation, it looks like Exelixis is now trading just under their average price to earnings ratio over the past 3 to 4 years, sitting at a PE of 24 times. However, this company currently has a 6.22% free cash flow yield, which is way higher than the long-term inflation rate of 3%. And this actually suggests that the company may be undervalued at current prices. And when we look at risks and possible challenges, of course the main one for healthcare companies is always going to be regulation and possible upcoming regulation changes. For example, changes to the Medicare plans, changes to the amount of expenditure that the healthcare program actually has in the US, or even changes in patents on the duration, on the difficulty to actually access them, or other type of regulations. This is always key when it comes to pharma, as they're very sensitive to this. Whenever they're going to be more protected when developing a product, they will invest more, and if they find that the landscape is less attractive, well, they will invest less in R&D. And the other key risk that I see is them not meeting performance objectives, and this I would measure in them not being actually able to meet the expectations with their pipeline or with the products that they're currently developing. One of the main risks for these companies is that the tests that are conducted in order to advance the products over clinical phase trials actually do not succeed and do not actually pass the thresholds that would entitle it to become an approved product. Now, before we move on, please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that Exelixis has a strong competitive advantage, they generate consistent cash flows, and they have a higher return on capital employed. So overall, I believe that they are a good company and they will probably be a good investment. However, they're highly dependent on regulations and clinical trial results, which are two things that we cannot control. So anyways, thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I will see you in the next one.